This is United Kingdom. Once the richest country is now in deep trouble. Many wealthy countries contain poor regions. America has the rural south and the Mexican border area, Germany has the former East Germany, and Italy has the lower part of the boot. But Britain is a bit different. Between the north of this line and south of Hadrian's Wall lies an area that is as poor as the American state of Alabama. The regions here contain 47% of Britain's population. This shows how household income varies across the UK. Compared to other parts of the United Kingdom, London and the South East had the highest income and productivity in 2018. But since COVID-19 has knocked the country back, the streets of central London are quieter than elsewhere. Due to the economic fallout of Russia's invasion of Ukraine, households are struggling to manage surging energy and food prices, along with increasing rents and mortgages. According to the Office for National Statistics, more than 90% of the population have noticed their cost of living increase, with many finding it difficult to pay the bills. Not only is the UK the only major economy to be still shrinking, but it is the only one not to have recovered the economy lost during the pandemic. In fact, the UK has an economy 0.4% smaller than it was before the pandemic, and if forecasts are right about a prolonged recession, it could be half a decade without growth. So, what's the real problem with Britain's economy? To understand this, we need to first understand the 5 major factors in play. Inflation is the rate at which the price of goods and services is increasing, and this is at the highest level seen for decades in the UK. In May 2023, consumer price index inflation hit 9.7%, meaning something that would have cost £100 a year ago costs £109.07 today, and this was among the highest across advanced economies. Even the food price inflation was among the highest across G7 economies, second only to Germany. In the past 5 years, the price of 4 frozen beef burgers has jumped 64.4%, from £2 to £3.32, much of that in the past year alone. The milk, cheese and eggs products category has recorded one of the highest annual inflation rates, a 30% increase in groceries in the 12 months. UK's annual energy price inflation was the highest among G7 economies in March at about 40.5%, mainly led by gas prices. This compares with single-digit energy price inflation in most major European economies and declining energy prices in US and Canada. In a bid to bring down soaring inflation, the Bank of England has raised the base rate of interest to 3.5% after years of rates below 1%. This means the interest paid on debts, such as mortgages and loans, is going up, and also interest paid on savings is increasing. There are 2 important questions to reflect on in this situation. The first question is, given that the current inflation is caused by global price increase, is there a limit on how effective raising UK interest rates will be? The second question is, how long will the bank continue to raise interest rates? Rishi Sunak has announced that there will be no Treasury support for struggling mortgage holders and has urged the banks to support homeowners. However, banks are anticipating UK inflation to remain high and are pulling mortgage deals and raising rates. Renters will bear the brunt of increasing mortgage rates, whereas landlords are seeing the mortgage payments on their properties go up and are subsequently increasing their rents to maintain profits. Private rental prices rose by 4.7% in the UK in the past 12 months, and this was an increase from the January figure, which stood at 4.4%. The bond markets are also affected. The Economist estimates that when UK inflation is at 2%, the profit return on a 10-year government bond will be worth 82% of its original value, whereas when inflation is 4%, that figure falls to 68%. Even if we compare the current inflation rates in France, Germany, and the US respectively, they are much lower than that of the UK. To answer the second question, there are 2 choices ahead of us. First, the Bank of England could continue to address the issue of inflation with monetary tightening, as it currently does until it hits its target inflation rate of 2%. However, subsequently the Volcker shock led the US into a deep recession and high rate of unemployment. In our opinion, the Bank of England must avoid Volcker's mistake on stamping out inflation this way. The second option is for the government to regulate prices via fiscal means. The Treasury should be supporting the most vulnerable UK households by working with businesses and other organizations to address the issues of sticky inflation and cost of living crisis. Supporting people with rents and mortgages is something that the government should urgently focus on. The UK economy shrank by 0.1% in May 2023, and in November the Office for Budget Responsibility confirmed that the UK is already in recession. The UK is the only G7 economy that has failed to achieve its pre-pandemic GDP level by the middle of this year. Since 2016, the UK economy has declined from being 90% the size of the German economy to being just 70% now. It is estimated that the UK economy fell by 2% since the 2008 financial crash, while the economies of Germany and France grew by 27% and 34% respectively. In fact, the UK economy has been flatlining since the 2008 financial crisis. According to the Food Foundation, 1/4 of UK households are now in food poverty. Out of a 68 million UK population, 14.5 million people live in poverty, including 8.1 million working-age adults, 4.3 million children, and 2.1 million pensioners. The socio-economic changes have been so profound since the UK economy has become the leader of a new global economic system known as rentier economy, where economic activities are guided to earn unearned income, which is also known as economic rent. The drive for unearned income has made a deep mark on the business culture of the country. Between 2008 and 2021, the UK economy could not even recover from the 2008 global financial crisis, let alone Brexit and the pandemic. Since the mid-1980s, the real income in the UK has been on a downward trajectory, and income inequality has been on the rise, creating a deep social and political divide. Many issues facing the UK, such as soaring gas prices, are global problems affecting other countries too. However, the UK is faring particularly badly compared to other rich countries. The impact of a struggling economy is felt in people's pockets. While prices have risen steeply, pay has not kept up. When adjusted for inflation, growth in total and regular pay fell in real terms by 1.2% for total pay and 0.8% for regular pay, reducing the spending power of workers. The figures for unemployment are more positive. Currently, 4% of the working-age population is unemployed, a low level by historic standards. However, the rate has increased slightly in the most recent quarter, driven by those aged 16 to 24. The OBR predicts the level will rise to 4.9% by the year-end as the economy battles a recession. In its analysis of the UK economy, the OBR made a stark assessment of how the country's problems will hit ordinary people. Living standards are set to decline by the biggest margin ever recorded next year, with disposable household incomes dropping by 4.3%. The decline will drag living standards back down to 2013-2014 levels and will not recover for another 6 years. Also, blaming a select group of foreigners for its economic woes, such as via Brexit against Europe and via Ukraine against Russia, will not really distract people's attention when they are faced with lack of food and fuel.